Accounting for Not-for-Profit Organizations. I am Harjinder, your instructor for the course. The material covered in this lecture is taken from Chapter 12 of your Modern Advanced Accounting in Canada textbook by Hilton and Hiroff. So taking a look at what a not-for-profit organization is, the definition provided in the not-for-profit accounting standard 4400, paragraph 2, is that not-for-profit organizations are entities normally without transferable ownership interests, organized and operated exclusively for social, educational, professional, religious, health, charitable, or any other not-for-profit purpose. A not-for-profit organization's members, contributors, and other resource providers do not, in such capacity, receive any financial return directly from the organization. So how do not-for-profit organizations then differ from businesses? So they differ from businesses, for-profit businesses, or profit-oriented businesses along 4 lines. First of all, not-for-profit organizations provide goods or services to segments of society without an expectation of profit, whereas a for-profit or profit-oriented business will provide goods and services to customers or clients with an expectation of making a profit. The second point of difference is that the resources that are required by not-for-profit organizations to provide these goods or services to the segments of society that they serve come from public donations or government grants. In contrast, a profit-oriented business will raise resources from its shareholders in the form of equity or by borrowing from financial institutions. Now, not-for-profit organizations also do borrow money from banks if the need arises, but the primary resources they need to carry on their operations tend to come by way of public donations or government grants. Third point of difference is that there is no ownership interest in a not-for-profit organization, whereas all for-profit businesses have owners. Finally, while not-for-profit organizations may have paid employees, they are governed by volunteers. The board of directors for a not-for-profit organization consists of volunteers. They are not paid positions. On the other hand, the board of directors for a company, public company, will typically have individuals who are appointed and are paid an honorarium. They are not volunteers. They are representatives of shareholders. Next up, we'll take a look at the accounting standards for not-for-profit organizations. So what accounting standards will apply? It depends on the type of the not-for-profit organization that we are talking about. For private not-for-profit organizations, these are not-for-profit organizations that are started by private individuals or groups. Part 3 of CPA Accounting Handbook applies. Recall the CPA Accounting Handbook. Part 1 is IFRS. Part 2 is Accounting Standards for Private Enterprises. Part 3 is the set of standards that applies to private not-for-profit organizations. Now, government not-for-profit organizations must follow the CPA Canada Public Sector Accounting Handbook. And they may do so with the 4200 series or without the 4200. More on this later on. Primary sources of revenue for not-for-profit organizations, we've briefly alluded to them. They could comprise of either contributions from individuals, which may be donations, user fees, or some sort of membership dues, and grants from governments or quasi-governmental bodies. The key accounting standards that apply to not-for-profit organizations from Part 3 of the Accounting Handbook are Section 4400, which describe the financial statements required by not-for-profit organizations, Section 4410, which deals with contributions and revenue recognition by not-for-profit organizations, Section 4420, which relates to contributions receivable, 4433, which talks about tangible assets held by not-for-profit organizations, Section 4434, intangible assets held by not-for-profit organizations, Section 4441, collections held by not-for-profit organizations, Section 4450 deals with reporting by not-for-profit organizations of controlled and related entities. Section 4460, which deals with disclosure of related party transactions required from not-for-profit organizations. And finally, Section 4470, which deals with disclosure of allocated expenses by not-for-profit organizations. Now, for our course, we do not necessarily have to memorize these section numbers and what they deal with, but we should be aware and familiar with the basic contents of these accounting standards, the basic import of them. So let's take a look at each one of these one by one. Section 4400, financial statement presentation by not-for-profit organizations. NFPOs must present 4 financial statements along with related note disclosure. And these 4 financial statements are analogous to the 4 financial statements prepared by for-profit businesses. These include the statement of financial position, statement of operations, statement of changes in net assets, and a statement of cash flow. The statement of financial position is similar to a balance sheet, or it is basically the same term expression used for a balance sheet prepared by a regular business. And it basically presents the assets and liabilities for the organization. What you will notice is instead of using the term equity or shareholders' equity, in not-for-profit organizations, the difference between assets and liabilities is called net assets. Keep in mind that there is no ownership interest in a not-for-profit organization, hence the difference between assets and liabilities is called net assets. On the screen, you can see the statement of financial position for the Calgary Food Bank, whose proper registered name is the Calgary Interfaith Food Bank Society, for as of August 31st, 2019, which was the most recent annual report that I could find for this not-for-profit organization. And you can see that the Calgary Food Bank has, just like any other business, it has assets which include cash and cash equivalents, short-term investments, accounts receivable, prepaid expenses, long-term investments, and property, plant, and equipment. can also notice there are references to note disclosures. Liabilities also exist. You would notice there is something called deferred operating contributions. You will learn about this concept later on in this lecture, as well as deferred capital contributions. So not-for-profit organizations will sometimes have these kinds of liabilities called deferred contributions. And instead of equity, they have net assets. And notice there that the net assets are bifurcated into two. There's unrestricted net assets and internally restricted net assets as well. We'll talk about restrictions as well later on. Next up, we'll take a look at statement of operations. The statement of operations is basically the not-for-profit version of the income statement. Because not-for-profit organizations are not oriented towards recording profits or earning of profits, the statement is called, in a more generic manner, a statement of its operations. Report revenues and expenses. And the difference between the revenues and expenses is not called net income or net loss, but instead a more generic expression of excess of revenue over expenses, or if expenses were more, excess of expenses over revenues is used. In the case of the Calgary Food Bank, for the year ended August 31st, 2019, it had revenues that exceeded expenses by $459,000 and change. Third statement is a statement of changes in net assets, which is similar to the statement of changes in equity, except that for a not-for-profit organization, there is no concept of equity. So instead, we use the more generic caption net assets. Notice here that the Calgary Food Bank Society had its net assets bifurcated into unrestricted and internally restricted net assets. And you would notice that in the year 2019, there were transfers from the unrestricted fund to the internally restricted fund for capital replacement reserve for almost $2.4 million, transfers to investment in PP&E, $363,500, and a transfer to strategy fund of about $70,000. Net assets need to be segregated into unrestricted and restricted. And as we saw for the not-for-profit, the Calgary Food Bank not-for-profit organizations board may, from time to time, transfer funds from the unrestricted or general fund to reserves, which are also called internally restricted. Number 4 in the financial statements is the statement of cash flows. And the preparation of the statement of cash flows is pretty similar to that of a for-profit business. You would notice that the cash flow statement is broken up into the operating activities, investing activities, and financing activities. Now, the not-for-profit organization doesn't have owners, it doesn't pay out dividends. So you would notice that those kinds of cash flows don't show up on the statement of cash flow for the Calgary Food Bank that is presented on the slide. Okay, next up, we will take a look at section 4410, contributions, and specifically revenue recognition. So a contribution is a non-reciprocal transfer to a not-for-profit organization, either in cash or in the form of other assets, or a non-reciprocal settlement or cancellation of its liabilities. So keep in mind that for a business, there's always a sense of quid pro quo or reciprocity. A business provides goods or services to its customers or clients. The customer or client must pay the business cash or owe money to that business to be received later on. Alternatively, the business may have pre-received the cash and by providing the goods and services, cancel the unearned revenue liability. Now, for a not-for-profit organization, the donors or the government that provides grants do not get any goods or services back from the not-for-profit organization. So that's what makes the contribution a non-reciprocal transfer. The donor does not get anything similar in value to the amount that he or she donates. Government funding is also considered to be a form of contribution. However, the normal practice is to refer to such funding as grants rather than calling it contributions. And the intent there is to help users of the financial statements get a sense of how much money the society or the not-for-profit organization gets from the government and how much of it comes from individual or corporate donation. There tends to be more stability to government grants than is to individual donations. We may have noticed that, especially in the times of COVID, some individuals may have experienced life-altering changes in their own lives, which may place considerable stress on their ability to give as charitable donations. Governments tend to have more stability in their revenues. Now, that is not to say that such a calamity has not impacted government financing in the most radical ways, as we've experienced in Alberta in the year 2020. But usually, government grants will not disappear at the drop of a hat. So the contributions that are received by the not-for-profit organization may be of three types. They may be restricted for a specific purpose. They may represent an endowment, which is a lump sum contribution with the intention that the amount uh, be invested and any income earned from the investment is used by the not-for-profit organization, or they may be unrestricted. We'll take a look at each type in the next few slides. First off, with restricted contributions, it's a contribution that is subject to externally imposed stipulations. So when we speak of restricted contributions, the restriction must be externally imposed, okay? Must be imposed by the donor or the government. Stipulations that specify the purpose for which the contributed asset, could be cash or in kind, is to be used. So an example of that might be contributions for a specific program that is run or operated by the not-for-profit organization. Now, these restrictions that I've mentioned are stipulations that are imposed on how the resources must be used. External restrictions are imposed from outside the organization, usually by the contributor of the resources. Now, we have noticed in the earlier slide about internally restricted funds. So internal restrictions are sometimes imposed by the organization itself, usually through a resolution made by the board of directors. But when we speak of restricted contributions, restrictions on contributions may only be externally imposed. So watch out for this if you ever come across a case type question asking you how the contribution must be accounted for. If you find a restriction, you must make sure that it is an external restriction. Otherwise, the contribution, if the restriction were imposed by the board of directors of the not-for-profit organization, it will not be considered a restricted contribution and will simply be recognized as revenue immediately. We can have a contribution that is restricted for the purchase of a capital asset, or we could get a contribution of a capital asset itself. These are seen as restricted contributions as well. Next up, we have endowment contributions. Endowment contributions are a form of restricted contributions subject to externally imposed stipulations specifying, this is important to keep in mind, that the resources contributed must be maintained permanently, although the constituent assets may change from time to time. Now, that's the formal definition from the standards. The example here might be, say, the not-for-profit organization gets a lump sum donation, say $5 million, and the donor specifies that this $5 million must be invested in, say, some income-bearing securities, and only the income earned from the investment may be used, say, to pay scholarships. So because the 5 million donation cannot be used at all by the not-for-profit organization, it represents an endowment. Thirdly, unrestricted contributions. And the basic definition is it's a contribution that's neither a restricted contribution nor an endowment. So any other contribution will be seen as a unrestricted contribution. Next up, we'll take a look at contributed materials and services. So as we can see, this is not a contribution of cash. So any contribution of assets other than cash should be measured at fair value. The fair value should be estimated using market values, or if those aren't available, then municipal appraisal values, or you bring in, you get the services of an expert appraiser for that purpose. For contributed materials and services that are normally purchased, so if the not-for-profit would have normally purchased the materials or services it received in kind, fair value will need to be determined in relation to the purchase of similar materials and services. So an example of that would be food donations in kind received by the Calgary Food Bank. That concludes our discussion of contributions. Next up, we'll talk about fund accounting. So fund accounting is the set of accounting procedures that result in a self-balancing set of accounts for each fund that is established either by law or by contract or voluntarily by an organization. Now, the fund can include assets, liabilities. The difference of assets and liabilities is net assets, revenues, and expenses. And wherever appropriate, they could also have gains and losses. So essentially, fund accounting represents a complete set of books. So maintaining a separate set of books is basically what fund accounting relates to. And it involves a segregation of accounting, although it doesn't necessarily have to be a physical segregation of resources. So definitely the accounting has to be separated for each fund where the not-for-profit organization uses fund accounting. Now, when the not-for-profit organization decides to account for contributions, the society can choose one of two methods: the restricted fund method, where fund accounting is mandatory, or the deferral method, where fund accounting is optional. The society could use fund accounting or choose not to. And it's required under Section 4410 that the not-for-profit organization will select one of the methods above, either the restricted fund method or the deferral method, for recognizing contributions, and apply that method consistently to all contributions. So you either must go with the restricted fund method and apply that across the board, or choose the deferral method with fund accounting or without fund accounting and apply it across the board to all kinds of contributions, restricted, endowment, or unrestricted. Take a look at each one of these in slightly more detail. The restricted fund method is a specialized type of fund accounting that involves the reporting of details of financial statement elements. Remember, financial statement elements are assets, liabilities, net assets, revenues, expenses, so on, by fund. So reporting of financial statement elements by fund in such a way that the organization reports total general funds, one or more restricted funds, and an endowment fund if it is applicable. But where a restricted fund method's being used, you will see more than one fund exists. There would at least be one general fund in existence. Now, reporting of financial state elements segregated on a basis other than that of use restrictions is not what the restricted fund method is about. So if the not-for-profit organization chooses to present segregated information by program or by geographic location, but it does not correspond back to the nature of use, then that's not truly the restricted fund method. Right? The following slide gives us a decision tree to follow. So where the restricted fund method is used, you would notice there's three categories of contributions. You can have an endowment contribution, a restricted contribution, or an unrestricted contribution. If an endowment contribution is received, the revenue, the amount received for the endowment, is recognized as revenue in the endowment fund. If unrestricted contributions are received, the revenue, the amount received, is recognized as revenue in the general fund. Now, when a restricted contribution is received, the question arises, do we have an appropriate restricted fund or not? If we have an appropriate restricted fund, we will recognize the amount received as revenue in the appropriate restricted fund. So for example, if we have established a restricted fund for capital assets, we will record the contribution for or of a capital asset in that fund. Now, sometimes we may get a restricted contribution for which there is no appropriate restricted fund. If that were the case, then at the time the contribution is received, it is actually recorded as a deferred contribution liability. Later on, when the related expense is incurred, the deferred contribution liability is reversed and a related contribution revenue is recognized. This is basically the functioning of the deferral method. So the blurb here, recognize in the general fund in accordance with the deferral method, is where a restricted contribution is received, but there is no appropriate restricted fund available. Now, you may wonder, why not create a new fund? Very well, that can be done. If that would simply mean there is an appropriate fund newly created, and the amount received can be recognized as revenue right there. Sometimes there could be circumstances where it may not make sense. So an example of that might be the not-for-profit organization, suppose, is planning on, it's celebrating its silver jubilee, 25th year anniversary, and it's going to conduct a gala event for that purpose, and it was raising contributions for that particular purpose. Now, the Silver Jubilee or the 25th anniversary is a one-time event. Once you've celebrated your Silver Jubilee, it's never going to be possible for that society to celebrate its silver jubilee next year, right? I mean, that wouldn't make sense. So that is where it may not be appropriate to create a new restricted fund for that purpose. And so in that case, any contributions received for the silver jubilee celebrations will initially be recorded in the general fund, but deferred. And later on, when related expenses are incurred, they will be brought into income. Next, we have the deferral method. Now, under the deferral method of accounting, restricted contributions related to expenses of future periods are initially recorded as deferred revenue. Deferred revenue is a liability. So they are deferred initially and later on recognized as revenue in the period in which the related expenses are incurred. Keep in mind, expenses is different from expenditure. We're not talking about spending cash. We're talking about when the related expense is recorded. Endowment contributions are reported as direct increases in net assets because there can never be a related expense for the endowment contribution. The endowment contributions are not meant to be used by the not-for-profit organization. Only the income generated from the endowment contribution can be used. And all other contributions are basically reported as revenue of the current period. Organizations that use fund accounting in their financial statements without following the restricted fund method will account for contributions under the deferral method. So where the restricted fund method is not used, automatically the organization defaults to the deferral method. So how does that work? Here's the decision tree. So where the organization follows the deferral method, if an endowment contribution is received, we will report that endowment contribution as a direct increase to net assets. Remember, net assets is similar to what equity would be for a for-profit organization. If an unrestricted contribution is received, it will be recognized as revenue immediately. The big differences arise with regards to restricted contribution. So for restricted contributions, you have to be careful, what does that restricted contribution relate to? If the restricted contribution relates to expenses of the current period, then as a matter of expediency, we recognize the amount immediately as revenue. And this is just to help with the accounting, right? I mean, if the amount relates to expenses for the current period, rather than first record a deferred contribution liability and then wait for the reverse matching, of revenue to expenses, because the amount being received is for expenses of the current period, we recognize the amount as revenue immediately. Now, it could be that the money received is for expenses of a future period. If it is for a future period, then what we do is we initially record the amount received as deferred contribution, which is a liability, very similar to a for-profit business receiving an advance payment from a customer. You'll recall in that case, you record debit cash and credit unearned revenue, and later on, debit unearned revenue, credit revenue. So it's a similar sort of process. You will initially defer the amount received and recognize as revenue in the period when the expenses are recognized. So some of you may remember the matching principle from before. Matching principle said match revenue, match expenses in the same time period as revenues are earned. In the case of not-for-profits, we follow a reverse matching principle where revenues are recognized in the same time period as expenses. Now, a restricted contribution could be received for the purchase of a capital asset. If that were the case, if the capital asset is depreciable, we will defer contribution and recognize as revenue on the same basis as amortization expense. If the capital asset is not amortizable, for example, land, then it will be recorded as a direct increase in net assets. So the big question is, will there be an expense in the future? If yes, defer for the time being, later on bring into revenue. Match revenue to expenses. If the capital asset is non-depreciable, record as a direct increase to net assets. Now, finally, if the restricted contribution is for the repayment of debt, then depending on the purpose of the debt, recognize based on that. So if you're receiving money to repay long-term debt, the amount will be brought into play accordingly. Or current debt, you'll record immediately, so on. Let us compare the deferral method and the restricted fund method and summarize a few slides that we've looked at. So first of all, if a contribution is received and it's unrestricted and for the current year, under both the deferral method and the restricted fund method, we will recognize the contribution as revenue. Important thing to keep in mind is that as far as the restricted fund method is concerned, we must record as revenue in the appropriate fund. If the contribution received is unrestricted, but for a future year, under both the deferral method and the restricted fund method, we will record it initially as a liability. Later on, recognize revenue when the related expenses are incurred. Or essentially, you will wait until the following year, the future year, before recognizing as revenue. If a restricted contribution is received, then under the deferral method, the contribution is initially recorded as a liability and later on reverse matched when the associated expenses are incurred. Under the restricted fund method, the restricted contribution is recognized as revenue in the appropriate fund immediately. A donation of or for depreciable capital assets, deferral method, it'll initially be recorded as a liability and later on recognized in revenue on the same basis as depreciation expense. Restricted fund method, no need to wait, recognize as revenue in the appropriate fund. A donation of or for non-depreciable capital assets, because it would not be possible to ever reverse match revenues against expenses because these are non-depreciable. Under the deferral method, we will record them as a direct increase to net assets. Under the restricted fund method, we'll record as revenue in the appropriate fund. If an endowment is received, under the deferral method, again, because for the endowment, there can be no reverse matching of revenues to expenses, the amount of endowment received is recorded directly as an increase to net assets. Under the restricted fund method, we recognize the endowment as revenue in the endowment fund. Next, we'll take a look at section 4420, which deals with contributions receivable. So this section says a contribution receivable should be recognized as an asset when it meets the following criteria. A, the amount to be received can be reasonably estimated, and B, ultimate collection is reasonably assured. Now, this is important. Why? Because unlike accounts receivable for a for-profit business, an account receivable implies that revenue has been earned by the business, that the business has provided goods or services to the client or customer, and as a result, has a legally enforceable right to receive payment from that client or customer. In the case of a not-for-profit organization, there is no reciprocity. Donors don't get similar value in return from the not-for-profit organization. We're talking about contributions receivable. So this is where potential donors have promised, they have pledged to give some money to the not-for-profit organization. The not-for-profit organization cannot enforce that promise. So this is why the organization has to be able to reasonably estimate the amount that it can collect. And there is reasonable assurance that the amount will get collected in the future. Either of the two is missing, then the society, the not-for-profit, should not record a contribution receivable asset. It should wait until actual collection occurs. Section 4433 deals with tangible assets held by not-for-profit organizations. Tangible capital assets are identifiable tangible assets which meet all the following criteria. They must be held for use in providing services or administrative purposes, for production of goods, or for the maintenance, repair, development, or construction of other tangible capital assets. Now, this definition is pretty similar to the definition for property, plant, and equipment for a regular for-profit organization. They've been acquired, constructed, or developed with the intention of being used on a continuing basis. They are not intended for sale in the ordinary course of operations, because that would make it inventory. And they are not held as a part of a collection. Collections are somewhat unique for a not-for-profit organization sphere, especially think museums. So the works of art that a museum holds is a collection. It's not a tangible capital asset, even though we can touch, feel, see the statues or paintings and stuff like that. Those are seen as a collection. They're not tangible capital assets. So how do we determine costs for a tangible capital asset? For a tangible capital asset that's been contributed to the not-for-profit organization, cost is deemed to be fair value at the date of contribution, plus all costs directly attributable to acquiring that capital asset. Now, the fair value may be estimated using market values or appraisal values. Now, there can be unusual circumstances where fair value can't be reasonably determined. If that is the case, then the tangible capital asset and the related contribution needs to be recorded at nominal value. Now, that nominal value could be $1, $1,000, some small number. The cost of a tangible capital assets that's developed or constructed by an organization may include contributed materials or labor, which will be recognized at fair value when contributed. Next, amortization and impairment of tangible assets. Just like for-profit organizations, capital assets must be amortized over their useful lives and should be written down if they're found to be impaired. Write-downs are accounted for as expenses in the statement of operations. They cannot be reversed. So any kind of an impairment write-down is not reversible. This is similar to the ASPE requirements. When a tangible capital assets carrying amount is written down, a corresponding amount of any unamortized deferred contributions that's related to that same tangible capital asset will be recognized as revenue, provided all restrictions have been complied with. So this would relate to where the capital asset being written down was originally contributed and had been, under the deferral method, initially recorded as deferred contribution liability. So if the capital asset is written down, the corresponding amount of deferred contribution will also be reversed and recorded as revenue. Now, interestingly, there is a small not-for-profit organization's exemption, which relates when we are dealing with tangible assets. So first of all, what's a small not-for-profit? Small not-for-profit organizations are those whose average annual revenues recognized in the statement of operations for the current and preceding period, and any entities that the not-for-profit may control, so on a consolidated basis, is less than 500,000. So you have a $500,000 sort of ceiling. The amount less than, if the average amount of the current year's revenues and the previous year's revenues is less than $500,000, then the not-for-profit organization is a small not-for-profit organization. Small not-for-profit organizations may, with regards to tangible assets, choose to expense the capital assets when they are acquired, so directly record them as an expense without bothering to capitalize. They may capitalize the asset but choose not to record amortization. Amortization is the Canadian GAAP term for depreciation, same idea. Or what normally businesses do, capitalize and amortize. Now, this exemption is available only to small not-for-profit organizations. Large not-for-profit organizations, i.e. those with average revenues of $500,000 or more, do not have this exemption. They must capitalize and amortize. And it's also important to keep in mind that a small not-for-profit organization remains small until it isn't. So if once a not-for-profit organization's 2-year average revenues exceed $500,000, it must comply with the requirements of Section 4433, which is capitalize and amortize, even if its average revenues later on fall below 500,000. So you cannot go back from being a not small, not-for-profit organization to a small. Okay, it's a one-time thing. Next, Section 4434, which deals with intangible assets held by not-for-profit organizations. An intangible asset, as we know, is an identifiable non-monetary asset that doesn't have a physical substance. So think about examples, patents would come to mind as the usual suspects. The accounting requirements for intangible assets are very similar to those for tangible assets under Section 4433. So I'm not going to repeat them. Section 4441 deals with collections held by not-for-profit organizations. Collections are works of art, historical treasures, or similar such assets that are being held for public exhibition, education, or research. So think about museums, or they are protected, cared for, and preserved, and are subject to an organizational policy that requires that any proceeds from their sale should be used to acquire other items to be added to the collection or for the direct care of the existing collection. So that would be a formal definition of a collection. So how do we determine the cost of collections? The costs of collections are made up of the purchase price of acquired items if the collectible items were purchased, the fair value of contributed items if we receive them as contributions, plus all other costs directly attributable to the acquisition of the items making up the collections, including installation costs, design and engineering fees, legal fees, survey costs, site preparation costs, freight charges, transportation costs, and duties. So, when we are dealing, so think about the head smashed in Buffalo Jump. That is a UNESCO conservation site. So all the costs that would have been incurred of that particular site, or think about the Drumheller Museum and the nearby sites, all of those will be considered to be costs of collections held by the related society. Of course, those are government, not-for-profit organizations, not private. But if there was, let's say, a private sector comparator, this would be the definition. The costs incurred in protecting and preserving collections is a repair or maintenance cost and must be expensed. So we make a distinction between repairs and maintenance and the acquisition costs. Acquisition costs and directly attributable costs that are directly attributable to the acquisition, these are capitalized. The cost of protecting and preserving the collection items is an expense, repair maintenance expense. The initial recognition of collections. Collections should be recorded on the balance sheet, the statement of financial position at either cost or nominal value. For items that are contributed to collections, cost is deemed to be fair value at the date of contribution, plus all costs directly attributable to the acquisition of the collection items. And we can estimate the cost, the fair value, either by using market values or appraisal values. However, if the value cannot be reasonably determined, then the items must be recorded at nominal value. Okay, so this would be just for specific items in the collection. This does not preclude the remaining items in the organization's collections from being recorded at cost. If a collection item purchased by a not-for-profit organization is substantially below fair value, the related item should be recognized at its fair value. And the difference between the consideration paid for that item and the fair value shall be reported as a contribution revenue by the not-for-profit. So for example, if the fair value of the item is $1 million and the um, not-for-profit organization was able to purchase it for $500,000, the difference between the $1 million fair value and the $500,000 paid by the not-for-profit, that difference will be recognized as a contribution. For a purchase collection item recorded at nominal value, the difference between the purchase price and the nominal value is recognized in the statement of operations. So say we purchased a 40,000-year-old set of something, right? Human remains, let's say, some bones and so on, um, from a um, from a company, let's say for $100,000, but we don't know, what the true value of that of those items is. So we chose to record the item as at a nominal value for $1. The difference between the purchase price, 100,000, and the nominal value, $1, that difference will be recorded as an expense or a cost in the statement of operation. It won't be capitalized. In addition, all other costs attributable to the purchase of the collection item are recognized in the statement of operations as well. This is where we've recognized the item itself at nominal value. Right? Keep in mind, we've paid the cash, right? We've incurred the cash costs. So credit cash for whatever actual amounts were expensed. If you're debiting the collection item for a nominal value, say $1, the difference between the cash we paid and the value we are recording the item at has to go somewhere, and that somewhere is the statement of operations. It's either a balance sheet item or an income statement item. So similar uh, understanding as a for a for-profit organization will apply here. Subsequent measurements for collections. Collections are not subject to amortization due to the nature of the collection, because the organization must preserve these assets in perpetuity. Now, it may be possible that collections need to be written down if their carrying amount is found to exceed fair value. If that ever happens, the write-down is allocated to the items in the collection that were recorded at cost on a pro rata basis using relative carrying amounts of those items. So if this was a bunch of items in the collection that have been found to be impaired, then the total impairment write-down is allocated to all of those items based on relative carrying amount. Reporting of controlled and related entities by not-for-profit, Section 4450. If a not-for-profit organization has control over another not-for-profit organization, it may choose to either consolidate or provide note disclosure. If a not-for-profit organization has control over a business, a for-profit organization, it may choose consolidation or the equity method. If a not-for-profit organization has joint control over a business, it can choose proportional consolidation or equity method. If a not-for-profit organization has significant influence in another NFPO, it must provide disclosure. Significant influence in a business has to be accounted for using the equity method. If a not-for-profit organization has economic interest in another entity, it must provide full disclosure of such economic interest. Other investments must be accounted for either at fair value for investments in shares or cost amortized costs if these are investments in bonds or such other debt securities. Section 4460, disclosure of related party transactions by not-for-profit organizations. There are considerable amounts of disclosures needed, including a description of the relationship between the transacting parties, description of the transactions, including those transactions for which no amount's been recorded, the recorded amount of the transactions classified by financial statement category, the measurement basis used for recognizing the transaction in financial statements, the amounts due to or from the related parties, and the terms and conditions relating thereto, contractual obligations with related parties separate from other contractual obligations, and contingencies involving related parties separate from other contingencies. So basically the idea here is that the scope of and the nature of transactions and relationships with other related parties must be separately and clearly presented from other kinds of obligations or relationships. The not-for-profit organizations may be in owing to contractual reasons. Last standard, section 4470, disclosure of allocated expenses. Paragraph 8, when allocations of fundraising and general support expenses have been made to other functions, the accounting policy disclosure must explain the policies adopted for the allocation of expenses amongst functions, the nature of the expenses being allocated, and the basis on which such allocations have been made. In addition, the amounts allocated from each of these two functions and the amounts and the functions to which they've been allocated should be disclosed. So how must this be implemented? There can be a number of bases that could be applied. For example, we could do the allocation based on time or usage or per capita based on number of people employed in that function or the space floor area occupied by a function. So the idea here is if there's a common cost and it has to be allocated, think about electricity costs, and a not-for-profit organization has 3 different programs that it operates, and it wants to allocate the cost of the administration costs to the 3 different program costs, then that allocation could be done based on time, number of people, space occupied, and so on. Some of you folks may remember service department cost allocations from your cost accounting course. This is somewhat similar to that concept. And that, my friends, brings us to the end of this lecture video. We will be looking at specific examples in class. Specifically, I'll be doing problems that demonstrate the journal entries for the deferral method and the restricted fund method, as well as time permitting, we would take a look at financial statement preparation. There are also practice problems that I've recommended, including the Connect practice problems. You would profit quite a bit from taking some time to do them. I look forward to seeing you in class soon. This is Harjinder. signing off from topic 1 of advanced financial accounting.